Every monetary collapse follows the same trajectory. First, confidence cracks, then fear spreads. Finally, panic drives money toward anything that cannot be printed, debased, or destroyed by political decree. Today, silver crossed $120 per ounce. Not gradually, not through steady accumulation by patient investors, but violently, desperately, as global markets began pricing in a reality that central bankers have spent decades trying to postpone. The reality that paper currencies, backed by nothing but political promises, eventually return to their intrinsic value, which is nothing. And when that realization spreads, when confidence in fiat money begins its terminal decline, precious metals don't just rise. They explode upward as the last stores of real value in a world drowning in synthetic wealth. This morning's breach of $120 wasn't a technical breakout. It wasn't algorithmic trading or momentum buying. It was fear. Pure, unfiltered fear that the monetary system built over the last 50 years is approaching its mathematical limits. The question everyone is asking is whether this is a pullback or a continuation, whether silver will retreat to more reasonable levels, or whether this is the beginning of a much larger monetary reset. History provides the answer, and history is rarely kind to paper promises. But before we examine what comes next, we need to understand what brought us here. Because this moment didn't emerge from nowhere. This moment has been building for years, accumulating pressure like water behind a weakening dam until the structural integrity could no longer hold. The catalyst for today's silver surge began not in precious metals markets, but in currency markets, specifically with the coordinated debasement of every major fiat currency simultaneously. Since 2020, global central banks have created approximately $18 trillion in new money. $18 trillion. That's not economic growth. That's not wealth creation. That's monetary expansion on a scale never before attempted in human history. The Federal Reserve's balance sheet expanded from $4 trillion to $9 trillion. The European Central Bank increased money supply by 65%. The Bank of Japan doubled down on negative interest rates while purchasing virtually every Japanese government bond in existence. The People's Bank of China expanded credit by 40% to prevent property market collapse. Everywhere you look, central bankers chose the same solution to every economic problem. Create more money, print more currency, expand more credit, postpone consequences through monetary expansion. But monetary expansion has mathematical limits, and those limits are now visible in precious metals markets. When you increase the supply of money faster than the supply of goods, prices rise. When you increase the supply of money faster than economic growth, purchasing power declines. When you increase the supply of money while simultaneously destroying confidence in the institutions that issue it, people seek alternatives. Silver is that alternative. Unlike fiat currencies, silver cannot be created by central bank policy. Unlike government bonds, silver cannot be defaulted on through political decision. Unlike digital assets, silver cannot be seized through regulatory decree. Silver is physics, tangible reality, a store of value that has preserved wealth through every monetary crisis in recorded history. And today, as fiat currencies approach their mathematical breaking point, silver is remembering its role. But the current surge isn't just about monetary policy, it's about the collision between infinite monetary expansion and finite physical resources, a collision that was always inevitable, but is now accelerating toward its logical conclusion. Consider the mathematics of current silver supply and demand dynamics. Annual silver production, approximately 1 billion ounces globally. Annual silver consumption, approximately 1.2 billion ounces globally. That's a structural deficit of 200 million ounces per year. Under normal circumstances, that deficit would be filled from existing inventories. Silver stocks accumulated over decades would gradually flow into markets to balance supply and demand. But circumstances aren't normal, and inventories aren't flowing into markets. They're flowing out of markets. COMEX registered silver inventories have declined by 73% since 2020. London Metal Exchange, silver stocks down 58% over the same period. Shanghai Futures Exchange, reporting the lowest silver inventories in 15 years. Meanwhile, demand continues accelerating. Electric vehicle production consuming approximately 80 million ounces annually, solar panel installations requiring roughly 120 million ounces per year. 5G infrastructure buildouts demanding silver-intensive components for every cell tower and data center. Industrial demand for silver isn't discretionary. You cannot manufacture semiconductors without silver. You cannot build solar panels without silver paste. You cannot construct electric vehicle batteries without silver components. As green energy mandates expand globally, as digital infrastructure requirements multiply, as artificial intelligence data centers proliferate, industrial silver demand grows exponentially while supply remains constrained by geological reality. This is the foundation beneath today's price surge. Not speculation, not momentum trading, but the mathematical certainty that demand for a finite resource is growing faster than supply can respond. and mathematical certainties don't care about political preferences or central bank policies. But there's another layer to today's silver surge that makes it particularly significant. A layer that suggests this isn't just industrial demand or monetary debasement, but something more fundamental: geopolitical realignment. For 75 years, global commerce operated under a dollar-dominated system. Oil priced in dollars, international trade settled in dollars, central bank reserves held in dollars, the entire architecture of global finance built around American monetary hegemony. That system is breaking down. Russia and China conducting trade in rubles and yuan rather than dollars. BRICS nations developing alternative payment systems that bypass SWIFT networks. Middle Eastern oil producers accepting payment in gold rather than dollars. European Union exploring digital euros to reduce dollar dependency. Each development individually appears manageable. Collectively, they represent the systematic dismantling of the dollar's role as global reserve currency. When reserve currencies lose their privileged position, the adjustment isn't gradual. It's sudden, violent, and irreversible. Sterling lost reserve status between 1931 and 1945. The gold-backed dollar system collapsed between 1968 and 1971. The current fiat dollar system shows similar stress patterns. And when reserve currencies collapse, capital flees toward alternatives. Not slowly, not thoughtfully, but desperately, seeking any store of value that promises stability in an unstable world. Silver, along with gold, represents the ultimate alternative. Assets that existed before fiat currencies and will exist long after fiat currencies disappear into historical footnotes. This is why today's breach of $120 feels different from previous silver rallies. This isn't speculative buying based on inflation expectations. This is systemic buying based on currency replacement. But the most significant aspect of today's surge isn't the price level itself. It's the velocity. The speed at which silver moved from $100 to $120 reveals something crucial about market psychology and physical dynamics. Silver traded at approximately $103 per ounce at market close Friday. By Monday morning Asian trading, silver had reached $115. By European market open, $118. By New York trading, $120. $17 and approximately 18 hours of active trading. That's not normal price discovery, that's panic buying combined with supply exhaustion. When prices move that rapidly, it indicates that available supply at lower prices has been completely absorbed. Every seller willing to accept $105, $110, or $115 per ounce has already transacted. The only remaining sellers are those demanding $120 or higher. This pattern typically emerges when physical markets disconnect from paper markets, when buyers demand actual delivery rather than paper promises, when the gap between available supply and urgent demand becomes unbridgeable except through violent price adjustment. And that disconnection is accelerating. Reports from silver dealers across North America indicate unprecedented demand for physical metal combined with extremely limited availability. Coin shops selling out within hours of receiving inventory. Bullion dealers implementing purchase limits due to supply constraints. Industrial buyers expressing concern over securing adequate silver for manufacturing operations. This isn't typical retail buying, driven by price momentum. This is institutional buying, driven by supply security concerns. Manufacturing companies that require silver for production cannot afford supply disruptions. Electronics firms that embed silver in products cannot substitute alternative materials. Solar panel producers that depend on silver paste cannot halt production while waiting for lower prices. When industrial buyers compete with investment buyers for limited physical supply, price becomes secondary to availability. And availability is becoming the primary concern in silver markets. But here's what makes today's situation particularly dangerous for anyone holding paper silver rather than physical metal. The gap between paper prices and physical prices is widening rapidly. While COMEX silver futures trade at $120, physical silver in certain markets commands significantly higher premiums. Reports from Asia indicate physical silver transactions at $135 to $140 per ounce. European dealers quoting $128 to $132 for immediate delivery. This premium structure suggests that paper markets are understating the true scarcity of available silver. Futures contracts assume deliverable supply exists at contract prices. But if physical delivery requires premiums of $10 to $20 above futures prices, then futures prices are fictional. And fictional prices have a tendency to converge with reality. Usually, suddenly, violently, and without warning. The historical precedent is clear. During periods of monetary crisis, precious metals experience initial surges, followed by brief pullbacks, before resuming upward momentum at accelerated pace. 1979 to 1980. Silver rose from approximately $6 per ounce to $50 per ounce in 18 months. The surge included multiple pullbacks of 10 to 15% that appeared to signal trend reversal. Each pullback attracted sellers expecting normalization. Each subsequent rally exceeded previous highs with increasing velocity. 2010 to 2011, silver rose from $18 per ounce to $49 per ounce in approximately 10 months. Multiple corrections of 8 to 12% occurred within the broader uptrend. Each correction was followed by renewed buying that drove prices to new highs. The pattern repeats because the underlying dynamics remain consistent. When monetary systems destabilize, when confidence in fiat currencies erodes, when physical supply becomes constrained while demand accelerates, precious metals don't move in straight lines, they move in waves, each wave higher than the previous wave, until the underlying crisis resolves. Current crisis shows no signs of resolution. Central banks continue expanding money supply to service unpayable debt levels. Governments continue spending beyond their means while promising even greater spending in future periods. International monetary cooperation continues deteriorating as nations pursue conflicting economic strategies. Meanwhile, silver supply remains constrained by geological limitations, while demand grows exponentially due to technological transformation and green energy mandates. These conditions don't suggest pullback. They suggest continuation, but continuation doesn't mean straight-line appreciation. Silver will likely experience corrections. 10%, 15%, possibly 20% from current levels. These corrections will trigger commentary about bubble peaks and rational profit-taking. The corrections will be temporary. The fundamental forces driving silver higher are structural, not cyclical. For anyone wondering whether to buy silver at $120 or wait for lower prices, history suggests that waiting for lower prices during monetary crises is typically expensive strategy. Those who waited for gold to return to reasonable levels during the 1970s watched gold rise from $35 to $850 per ounce. Those who waited for silver to normalize during the late 70s watched silver rise from $6 to $50 per ounce. Reasonable levels don't exist when monetary systems approach mathematical limits. Only mathematical levels exist, levels determined by the relationship between money supply and available goods, between currency creation and economic production, between political promises and physical reality. Current levels of monetary expansion, combined with current levels of silver scarcity, suggest that $120 per ounce may appear inexpensive within 12 months. Not because silver has become more valuable, but because the currencies used to price silver have become less valuable. This is the crucial distinction that determines whether today's surge represents pullback opportunity or continuation signal. If you believe central banks will reduce money creation, governments will reduce spending, and confidence in fiat currencies will stabilize, then $120 silver represents temporary overshoot requiring correction. If you believe monetary expansion will continue, fiscal deficits will widen, and currency confidence will deteriorate further, then $120 silver represents early stage of much larger repricing. The evidence suggests the latter scenario is more probable. Federal Reserve balance sheet expansion continues despite inflation concerns. European Central Bank maintains negative interest rates despite currency weakness. Japanese monetary policy remains committed to unlimited bond purchases despite debt sustainability questions. Chinese credit expansion accelerates despite property market instability. Nowhere among major central banks do you find policies consistent with monetary restraint or currency stabilization. Everywhere you find policies consistent with continued debasement and eventual currency crisis. And currency crises always resolve through flight to hard assets. Assets that cannot be created by policy decree or destroyed by political miscalculation. Silver represents the ultimate hard asset, industrial necessity, monetary alternative, physical reality in a world of digital abstractions. Today's breach of $120 isn't the end of silver's repricing. It's the beginning. But the beginning of what? How high can silver realistically rise before economic systems adapt and find alternatives? The answer depends on variables beyond silver supply and demand. Variables that relate to the mathematical limits of fiat currency systems and the political willingness to address those limits honestly. If governments reduce spending to sustainable levels, if central banks reduce money creation to economic growth rates, if confidence in institutional management of monetary policy recovers, then silver may stabilize at current levels and gradually decline as crisis psychology fades. If governments continue spending beyond their means, if central banks continue expanding money supply beyond economic fundamentals, if confidence in fiat currencies continues deteriorating, then silver could reach levels that currently appear impossible. $300 per ounce, $500 per ounce. Levels that reflect not silver appreciation, but currency depreciation, accelerating beyond political control. The historical precedent exists. Weimar Germany experienced precious metals appreciation of several thousand% as the mark collapsed. Zimbabwe experienced similar precious metals performance as their currency became worthless. Venezuela continues experiencing precious metals gains as the bolivar approaches zero value. The difference today is scale. Global currencies weakening simultaneously rather than individual currencies collapsing in isolation. Coordinated monetary expansion rather than localized policy mistakes. Systemic rather than regional crisis. When systemic crises resolve, the resolution affects every currency, every market, every assumption about value and measurement. And precious metals, being the ultimate measurement standard, often experience repricing that dwarfs historical precedents. $120 per ounce may represent the early stages of such repricing, or it may represent speculative excess requiring correction before normalizing at more sustainable levels. The distinction matters enormously for anyone making decisions based on current price action. But here's what matters more than predictions about future price levels. The demonstration that precious metals markets can move 20% in a single trading session reveals something fundamental about the stability of current monetary arrangements. Stable monetary systems don't generate 20% daily moves in store value assets. Stable monetary systems maintain predictable relationships between currencies and commodities. Stable monetary systems inspire confidence rather than panic buying. Today, the silver surge suggests that monetary stability is deteriorating faster than political authorities acknowledge or financial markets previously recognized. And deteriorating monetary stability, regardless of short-term corrections in precious metals prices, ultimately resolves through return to sound money principles. Principles that require hard assets backing currency rather than political promises supporting paper. Silver touched $120 today because mathematical reality is asserting itself against political fantasy. Whether silver continues rising or experiences temporary pullback, the underlying mathematics remain unchanged. Infinite monetary expansion cannot continue indefinitely in a world of finite resources. And when infinity meets finitude, finitude always wins. The world is beginning to panic, not because silver reached $120, but because silver, reaching $120, reveals how close we are to monetary mathematics overwhelming monetary politics. Pullback or continuation? The question misses the larger point. The larger point is that precious metals are remembering their purpose while fiat currencies approach their limits, and that remembering has only begun.